Did you know that your life insurance can do more than just protect your family? What if I told you it can help you build a house, start a business, or even fund your dream vacation? Today we're going to explore exactly how. I'm Gregory Rozdeba, the CEO of Dundas Life. Over the last few years, I've helped hundreds of Canadians unlock financial opportunities with their life insurance that they never knew existed. And today, I'll show you how to do the same. Throughout this video, we'll break down aspects of whole life insurance into easy to understand concepts, explore how something called cash value accumulates over time, and even discuss some common misconceptions that often keep people from taking full advantage of their policy. Whether you're planning for your children's education, funding your retirement, or looking to create a lasting legacy, this video is for you. Don't forget to like and subscribe for more educational content protecting your financial future. Now let's dive in. First, let's start with the basics. What is whole life insurance and why is it a popular choice when it comes to life insurance? Whole life insurance is a type of permanent insurance that, unlike term insurance, does not expire after a set number of years. It not only provides a guaranteed death benefit, but also builds a cash value component over the life of the policy. Many people think of life insurance as just the payout for your family when you're gone. However, with whole life insurance, you are setting up what is essentially a long-term, tax-advantaged saving plan. A well-designed whole life policy can offer early liquidity, meaning you can access funds easily while you're still alive, as well as steady and predictable cash value growth. Let's compare this to term insurance. Term life insurance covers you only for a specific period, say 10, 20, or 30 years. While monthly premiums might be lower, it's like renting a house. The benefits expire once your term expires, leaving you without any accumulated cash value or ongoing benefits. Whole life, on the other hand, continues to grow and serve as a financial asset without any expiry date. Imagine retiring with a financial cushion that grows year after year without worrying about market crashes. This guaranteed growth of a whole life policy offers a level of predictability and tax advantage that many traditional investments don't match. While the stock market may offer the chance for higher returns, that also brings volatility and risk. With whole life insurance, you have the certainty of stable, tax-deferred cash growth that doesn't depend on market performance. Now that you understand how whole life insurance works, let's take a closer look at the most important aspect, the policy structure. A well-structured whole life policy is made up of two components: the base insurance and the paid-up additions. Most people overlook this simple feature when structuring their policy, one that could double your cash value over time. Let's break it down, starting with the base insurance. This covers the core cost of your insurance, making sure that your death benefit is in place. While its primary function is to provide a guaranteed benefit, it also builds cash value quite slowly in the early years of your policy. In other terms, while your base insurance provides insurance protection, it's not the main driver of cash value growth. This is where paid-up additions come into play. Paid-up additions represent additional premium payments that directly contribute to the cash value of your policy. Every dollar allocated to paid-up additions immediately increases the cash value. It even adds to the death benefit. Think of paid-up additions as the engine that supercharges your policy's investment growth. In Canada, certain life insurance policy designs allow for a significant portion of your premiums to paid-up additions right from the start. This strategy enhances your policy's cash value accumulation, making it a more effective financial tool. Additionally, some policies include what's known as a term rider. A term rider is an add-on that temporarily increases the death benefit without significantly increasing your overall costs. This can be particularly useful if you need a higher death benefit while still maintaining strong cash value growth. It's important to find the right balance between the base insurance and paid-up additions. Overfunding the base premium could result in a policy that primarily serves as a death benefit with minimal cash value growth, whereas prioritizing paid-up additions can increase your policy's cash value, ensuring early liquidity and long-term growth. This is why working with an experienced life insurance advisor like Dundas Life, who specializes in whole life insurance, makes sense. Click the link in the description below to schedule your free call. Now, one of the key benefits of a well-structured whole life insurance policy is its guaranteed cash value growth. Unlike investments tied to market fluctuations, your policy's cash value grows steadily on a tax-deferred basis. This is what fuels the concept of infinite banking, where you act as your own banker by borrowing against your policy's cash value at favorable terms. To illustrate this, let's look at a real example. Meet Jason. He's looking to buy an investment property, but doesn't want to jump through the hoops of a traditional bank loan. Luckily, he purchased a participating whole life policy a few years ago, which now was $250,000 in cash value. He borrows $200,000 against the cash value of his insurance policy as a down payment on his property. Jason collects rental income and he uses part of it to pay his low-interest policy loan, while still continuing to grow his policy's cash value. For many, the ability to create a tax-free income stream while working or during retirement is one of the most compelling reasons to consider whole life insurance. Imagine supplementing your pension or CPP payment with funds you can access easily, without worrying about market downturns. This stability combined with predictable, compounding growth makes whole life insurance a powerful financial vehicle. The combination of guaranteed growth, unparalleled liquidity, tax advantages, and the potential for infinite banking makes whole life insurance a powerful tool that stands above many traditional investments. Now, let's see how whole life insurance stacks up to other financial products. How does whole life insurance compare with traditional retirement accounts like RRSPs and TFSAs, or even with universal life policies? The answer lies in unique benefits that whole life insurance offers. For starters, retirement accounts like RRSPs and TFSAs are fundamentally market dependent. While they may offer impressive returns at some points, they often expose you to market volatility and often to penalties if you need to withdraw funds early, in the case of an RRSP. With whole life insurance, you're guaranteed a steady, predictable growth that is not tied to market performance. This reliability provides a significant advantage if you're seeking long-term financial security without the stress of market downturns. Then there's universal life insurance, a type of permanent life insurance policy that combines a death benefit with a cash value component. Cash value grows based on the performance of a selected stock index. While this offers the potential for higher returns, it's important to note that universal life policies often come with complexities like caps, participation rates, and market risks, which can lead to unpredictable outcomes. Consider a scenario where you might need immediate access to funds, for instance, during an economic downturn. With whole life insurance, you have the option to take a policy loan against the cash value at any time, with fewer requirements than you'd face from a conventional bank loan. You don't need to worry about the cash value declining in a bad stock market year, so it's available when you need it. Ultimately, while each financial product has its merits, whole life insurance's unique combination of guaranteed growth, built-in liquidity, and tax-free access to funds establishes it as a highly valuable asset. Another misconception we often hear is that whole life insurance is too expensive. This is only true if you structure it the wrong way for your needs. When you work with an experienced advisor, like one at Dundas Life, who understands the intricacies of balancing base insurance with paid-up additions, you can significantly enhance your policy's performance and achieve your goals. Let's look at some real-life examples. Take Sarah, for instance. She always prioritizes her children's education, but was wary of taking on debt. Instead of using high-interest loans, she structured her whole life policy to build up cash value over time. When the time came, she borrowed against her policy to fund her children's post-secondary education, without derailing her own financial stability. Even better, as she repaid the policy loan, the money stayed within her financial ecosystem, continuing to grow tax-deferred. Then there's John. After years of hard work, John wanted to retire without the constant worry of the risky market reducing his savings value. By slowly borrowing against this policy, he created a tax-free income stream that covered his living expenses and allowed him to fulfill his longtime dream of traveling the world. Next, let's also cover some common mistakes whole life insurance policyholders make and how to avoid them. Overfunding the base insurance. Many people mistakenly put too much premium towards the base insurance instead of balancing it with paid-up additions. This approach may leave you with a sizable death benefit, but it can severely limit your cash value growth and ability to use it while you're still alive. Neglecting paid-up additions. Failing to take full advantage of paid-up additions can also result in missed opportunities for accelerated cash value growth. Remember, every dollar you direct towards these additions has an immediate impact on both cash value and your death benefit, ignoring the importance of early liquidity. Some policyholders overlook the benefit of early liquidity, delaying opportunities to use the cash value for investments, emergencies, or other financial needs. Failing to utilize these built-in advantages can limit your financial flexibility. Misunderstanding policy riders. Including or excluding additional features, like term riders, without fully understanding their impact can lead to policies that either overcharge you or don't meet your needs during critical moments in your financial life. Poor policy structuring. Choosing a one-size-fits-all policy without tailoring your financial goals can reduce your whole life policy's overall efficiency. Many of the criticisms you hear about whole life insurance arise from poorly structured policies. Ensure that you work with an experienced advisor who understands how to optimize the balances between protection and growth. A properly structured whole life insurance policy provides guaranteed tax advantage growth, early liquidity, and the flexibility to help manage emergencies, investment opportunities, and retirement income. It can serve as your personal bank, empowering you to access funds when you need them the most. Whether you're looking to fund your children's education, protect your business, or enjoy a tax-free source of income, a well-designed whole life policy holds the key to a secure financial future. The process starts with understanding the elements of an effective policy and working with an advisor who can help tailor a strategy around your personal and financial goals. Ready to put this knowledge into action? At Dundas Life, we're committed to providing you with the tools and knowledge needed to make informed decisions about your financial future. Book a personalized consultation by clicking on the link in the description below today. Thank you for watching. For more expert advice and tips on financial planning and life insurance, be sure to subscribe, like, and click the bell icon to stay updated. Whether you're just starting your journey or looking to enhance existing financial strategies, we're here to help.